everyone, today I Lavanya Jain of class 11th B is going to make a video on accounting principles. Accounting is a systematic process of recording, classifying, summarizing, interpreting the financial transaction and communicating the result to the users. It gives information on the resources available, how the available resources have been employed and how the results achieved by their use. According to the business entity principle, business is considered to be separate from its owners. Business transactions are recorded in the books of account from the business point of view and not from that of the owners. Owners being regarded as separate from business are considered as creditors of the business to the extent of their capital. According to the money measurement principle, transactions and events that can be measured in money terms are recorded in the books of account of the enterprise. This principle suffers from two major limitations. First, transactions and events that cannot be measured in money terms are not recorded in the books of account, however important they may be to the enterprise. Second, the value of money is considered to have static value as the transactions are recorded at the value on the transaction date. According to the accounting period principle, the life of an enterprise is broken into smaller periods so that its performance is measured at regular intervals. The accounts of an enterprise are maintained following the going concern principle, meaning the enterprise shall continue its activities for a foreseeable future. Users of financial statements, especially the management and banks, require information from the accounts at regular intervals so that decisions can be taken at the appropriate time. An accounting period is the interval of time at the end of which income statement, profit and loss account or statement of profit and loss in the case of companies and balance sheet are prepared to know the result and resources of the business. According to the principle of full disclosure, there should be complete and understandable reporting on the financial statements of all significant information relating to the economic affairs of the entity. Apart from legal requirements, good accounting practice requires all material and significant information to be disclosed. Disclosure of material informed will result in better understanding. Materiality principle refers to the relative importance of an item or an event. According to the American Accounting Association, an item should be regarded as material if there is a reason to believe that knowledge of it would influence the decision of an informed investor. Thus, whether an item is material or not will depend on its nature and or amount. It thus means that it is a matter of exercising judgment to decide which item is material and which is not, and only those items should be disclosed that have significant effect or are relevant. Conservatism principle is many a time described using the phrase do not anticipate a profit but provide for all possible losses. Stating differently, it takes into consideration all prospective losses but not the prospective profits. The application of this concept ensures that the financial statements do not paint a better picture than what it actually is. Conservatism principle prescribes that anticipated expenses and losses should be accounted. Thus, as a result, liabilities may be overstated. It has a drawback as it may be used to create secret reserve, and thus financial statements may not depict a true and fair view of state of affairs of the business. According to the cost concept, an asset is recorded in the books of account at the price paid to acquire it, and the cost is the basis for all subsequent accounting of the asset. Asset is recorded at cost at the time of its purchase, but is systematically reduced by charging depreciation. The market value of an asset may change with the passage of time, but for accounting purposes, it continues to be shown in the book of account at its normal book value. Cost concept brings objectivity in the preparation and presentation of financial statements. They are not influenced by the personal bias or judgment. An important objective of business is to determine profit periodically. It is necessary to match revenues of the period with the expenses of that period to determine correct profit or loss for the accounting period. Profit earned by business during a period can be correctly measured only when the revenue earned during the period is matched with the expenditure incurred to earn that revenue. It is not relevant when the payment was made or received. Therefore, as per this concept, adjustments are made for all outstanding expenses and prepaid expenses. According to the dual aspect concept, every transaction entered into by an enterprise has two aspects, a debit and a credit of equal amount. Simply stated, for every debit there is a credit of equal amount in one or more accounts. According to the revenue recognition concept, revenue is considered to have been realized when a transaction has been entered into and the obligation to receive the amount is established. It is to be noted that recognizing revenue and receipt of an amount are two separate aspects. The verifiable objective concept holds that accounting should be free from personal bias. Measurements that are based on verifiable evidence are regarded as objective. It means all accounting transactions should be evidenced and supported by business documents. These supporting documents are cash, memo, invoices, sale bills, etc. Thank you.